The rates debate is on. Fears of higher for longer rates driving the risk-off sentiment for investors. The bond market staging a bit of a rebound today, but yields still remain high. The 10-year yield pulling back from the highest level that we've seen of the year. We want to welcome in Lisa Erickson, U.S. Bank Senior Vice President. Lisa, it's good to see you. So we're getting ready to wrap up the week. We've seen a massive sell-off in bonds. We've seen equities come under a bit of pressure as a result. Investors trying to figure out what exactly is ahead for the Fed. But when you take a look at the move that we've seen in the bond market, what type of risk does this then signal for equities?
Certainly, this upward march in yields has been concerning for equities. And to your point, it's because you really have a relatively lower risk asset offering some nice income to investors. And so on the back of that, and also with the implications for the broader economy, where if you have higher borrowing costs, again, it makes it harder to generate that growth going forward. It certainly has been a concern for the stock market. Now, fundamentally, when we look at it, our expectations is that really all other things being equal, bond yield should start to have some more momentum downward, only just because when you look at underlying macro activity, we have seen it continue to slow. And generally, when you have lower demand and lower growth, you're going to have lower rates. But again, there's some technical momentum behind investors just really continuing to push those yields up. So it's something that we'll want to monitor.
So speaking of monitoring that, though, is fixed income the play to hide out in if we expect the Fed to keep up a tightening course?
Right now, Diane, we're actually neutral on fixed income, meaning that for our clients, what we recommend is whatever is their long-term or strategic allocation to fixed income, that they just stay put at that level, that they neither overemphasize it at this point or underweight it. And really the reason why is because while you're getting some very nice yields on fixed income, we do have this technical momentum continuing to potentially push those yields up and push the underlying bond prices down. And it's still yet unclear when the Fed will pause and pivot. So far in that tug of war between market expectations and what the Fed actually is doing, the Fed has won out. And so the Fed has stayed on that sort of higher for longer course, more so, and really been able to stick to that, even though the market keeps expecting them to pause and pivot.
Lisa, how much higher do you see the 10-year yield heading?
Well, it's hard to say exactly how far it is going to continue to move on. Certainly, if we continue to see a breakout, there is some resistance level at 5%, but 5% is still a pretty high number compared to where we are now. So it is, again, something that we're just going to want to continue to monitor. Again, though, if we look at the underlying fundamentals, we really see that all of those signs would point to yields beginning to come down over time. So it's that push and pull between current investor sentiment and what the underlying fundamentals on macro would tell you.
And then when you think about things that we're continuing to monitor, of course, it is the actions of the Fed. And next week, a big focus is on Jackson Hole. So what are your expectations for what we could possibly see come out of that?
Well, certainly in the last press conference, Fed Chair Powell really emphasized optionality and data dependence, really not making a commitment either way to what would happen with potentially another rate hike or if a pause would happen at that meeting. And so I think really the impetus is for him to keep that optionality open. Investors, including us, will certainly look for clues on anything he may say about ultimately where he wants to see interest rates end up. And again, other factors that the Fed is looking at to determine, again, when to pause. But since there is just so much data and time between now and the next meeting, the most likely odds are that he's just really just going to keep all options on the table.
Lisa, we're getting ready to wrap up second quarter earnings season. And when you take a look at the numbers of results that we got in compared to what we had been expecting heading into this earnings season, certainly showing that corporate America holding up much better than many analysts had feared that we would see. What's been your takeaway and how this positions us then for the final months of the year?
We have had a very solid second quarter earnings season. And if you look both at the percent of companies beating and the amount by which they beat, it was a very respectable amount. And so what companies are really showing is that they've been able to adjust to some of the difficulty in inflation pressures, whether it's in their cost inputs and also how they price back to consumers, as well as keeping volumes reasonable. When we go under the hood beyond that broad level, we are seeing, though, some signs of slowing. And so, for example, consumers are spending somewhat less on discretionary and focusing more on the essentials. And we even see a little bit of hint that some of that revenge spending on services is beginning to tick down a little bit. And so really the question for us going forward is, how long can the consumer continue to hang in there? Certainly there's some excess savings, but how long will that continue to propel them forward? And so those are some of the key questions we're going to want to see if that second half expectation right now, which is by the consensus for corporate earnings to be able to resume more of an upward trajectory, will actually happen.
And to your point, Lisa, about the weakness that we've seen, or some of the slowdown in the strength of the consumer that we've seen in some of these earnings, like for example, one of the places that stood out was Target this week. What is the expectation for the balance of the year when you think about the potential for, one of the things we've talked about a lot is the resumption of student loan payments and what that could do in terms of the strength of the consumer, and also to your point, with that excess savings starting to wind down, do we think consumers still hold up, especially when we see that there's been still job market strength?
Well, we're really at a neutral position right now on the U.S. equity market. And to your point, it's really because you've got these puts and takes. And so on the take side, certainly we do have the fact that it is going to be somewhat of a tougher road for consumers, with inflation having come down but still high. The student debt payments needing to kick back in, and excess savings we certainly know has come down over time. These are all headwinds to continued consumer behavior. On the other hand, we still have a very tight labor market, and we have an elevated number of job openings relative to the number of unemployed. So those bode well for the consumers being able to maintain their income and spending. So again, it's something that where we feel staying at that typical position you have in U.S. equities makes the most sense right now, and continuing to watch how that data unfolds.
Lisa, what about when we're talking about portfolio positioning right now? Obviously, a lot of focus in the first half of the year was surrounding the AI rally, tech being that outperformer. We've seen a bit of a rotation and a broadening when it comes to leadership. But when you're looking at tech at these current levels, are you still seeing a buying opportunity?
So for investors who are looking out more than a year, we certainly see technology and some of these more secular growth areas, like specific areas within communications or specific areas within consumer discretionary, as attractive. And the bigger picture why is many of the trends that we've seen play out over the last years, with increased use of cloud computing, now increased momentum, to your point, Shauna, around AI and machine learning, and continued consumer demands for anytime, anywhere connectivity. These all should continue to bolster these kinds of names. So again, for investors who can ride out maybe some of the nearer term chop as people become concerned about the wiggles and waggles of inflation and where policy may head, it continues to make sense to invest in some of those sectors.
All right, Lisa Erickson, thanks so much for joining us. Have a great weekend. U.S. Bank Senior Vice President. Thanks, Lisa.